Hi, welcome to Finances with Felton. My name is Jeremy, and today I want to talk about a health savings account. We're going to go over what a health savings account is, what it can do for you, and why I think it's so important in retirement. So stick with me, we'll go over it step by step. If you want to leave any comments down below and any questions, I will try to answer those, or if you just want to say hi. Also, if you could give me a big thumbs up and subscribe to my channel, I would really appreciate it. All right, let's get into it. A health savings account. What is it and how do you get one? So let's start with your health plan. You have to have a high deductible health plan. And don't worry, if you're not in one right now, that's okay. You can always change it. For instance, in the federal government is coming up open season, and you can change what your health plan is, but you have to make sure that it still works for you in your situation. But when you're looking at your options, if you look at the health savings plans, they're only if you have a high deductible health plan. So you have to have the high deductible health plan in order to get the health savings account. So when you're looking through your stuff, make sure you either filter it out, if you can get it on some type of Excel spreadsheet, or if you're just going through it, make sure that whatever health insurance that you're picking from Aetna, Blue Cross Blue Shield, GHA, and all the other different ones, make sure that it's a high deductible health plan because those are the only ones that are allowed to have the HSA or health savings account. Now that we understand how to get the HSA, what is the actual health savings account? It's just a savings account that has pre-taxed money in it that is provided by either your health plan or the money that you put into it. You can use. Okay, let's talk about the contributions. So if you are getting your health insurance and it's just for yourself, you can contribute $4,150 in total. If you are doing a self plus one or a family, you can contribute $8,300. So those are the limitations on how much you can actually put into the accounts for the year. And that is a total amount. So if the health insurance is paying some of that, which we'll take GHA for an example, they're going to give you for family $1,800. If it's self, it's $900. If I subtract that from the $8,300, if I'm a family, I'm going to get $6,500 left over. I could divide that up into all the payments I get throughout the year. So most people get paid bi-weekly. So 2 times a month, 26 periods that you're going to get paid. So if you divide that into 26 into that 6,500, you're going to get $250 per pay period. If you pay out $250 per pay period, you can max that out. And that'll give you the $8,300, again, if you're a family. And the same type of math is just done for the $4,150 if you're single. So if I have all of that maxed out, I can't go over the $8,300. I can't put in $8,300 and have my health insurance put in $1,800. I would be over the limit. It's only what's there. You don't have to put any money in. You can still get that $1,800 or $900 just to use for any type of medical issues that you have with the HSA also. Now, there's a catch to that. If you're older than 55 and still working, you can put in an extra $1,000. So it's called a catch-up. So if you're older than 55, you can put that extra $1,000. So it would be for this next year, either $9,300 for a self plus one or a family, or it will be $5,150 for just self. So depending on what you pick up for your health insurance, those are the numbers in total of what you can do for the year. Now I want to talk about either your retirement, whether it's a 401k or a TSP, depending on where you work and what you do. I think all this comes second to your retirement. If you are not putting in all the money you can into your 401k or TSP, this should just be an afterthought in the sense of putting more money into it. Definitely get a HSA if it's available to you and get the free money that the health insurances are going to give you because it will offset some of your medical costs, and maybe you can put that money into your retirement 401k or TSP depending on your situation. But I just wanted to and I will be putting together a retirement video here shortly. So let's talk about your health savings account. Once you open that health savings account, you will get a debit card. And so the money that the health insurance is putting in there will be accessed through your debit card. But you will also be able to pay for stuff over the counter or at your medical offices. Just swipe your card. It's that simple. The money will come out. The other side. Now I wanted to share with you some of just the common qualified medical expenses. This is not an inclusive list, but if you want to stop it, take a picture of it, whatever you want to do, you can always look this stuff up in your own HSA also. Let's look at some here. These are the common over-the-counter things that people buy. Same thing with this if you want to take a picture of it. So you can purchase this stuff with your card at CVS, at the Rite Aid, the Walgreens. You can purchase this stuff. And this will all come out of your card. So if you have your card, you could say, oh, I'm just going to the store and got to get some allergy and sinus medicine. Swipe the card. It's tax-free coming out of your card. So that money that was in there wasn't taxed. You're going to pay for this, and you've never been taxed on that money you're paying for. So that's how you'd use it. Now I wanted to get in some of the benefits of the HSA. One of the first benefits is that it's a triple tax benefit. So the tax benefit is the contributions are not taxed. Any money you make on those contributions, as in gains, are not taxed, and whatever withdrawals come out of there are not taxed. The gains part is if you want to invest the money that you get for your health insurance. So the money that comes in from the institution, as in the health plan, comes into your account. You can take that and send it off to whatever bank you use, as long as they have investments, or a Schwab or Fidelity or whoever you use. You can take that money and invest it into the stock market, into bonds, ETFs, depending on what you're looking for. And you can make gains on that money. The gains on that money for the HSA are then yours, tax-free. Whether you make $10 or $1 million, the money will never be taxed if you use it for the medical purposes that it's intended for. All you do is you take that money back out of whatever institutional bank that you had back into your HSA account, and you use your debit card to just swipe for whatever medical costs you might incur. The other benefit is that you can use it long term. You can use it forever. It's not like a flex spending account, if you are familiar with those, where you have to redo it every year and you can only roll over a certain amount of money. So if you put in $2,500 into your flex spending account and you didn't use it all, you could only roll over $500, $600, depending on what year it was. This last year was $500. This upcoming year, it'll be $610, I believe. So that's another benefit. This money will stay in there forever. When you retire, you can use it. There's also another very good benefit, in my opinion, and that's paying yourself back. So as you grow this money and say you just use your own out-of-pocket money to pay for all of your medical and over-the-counter medicines, you just keep your receipts. With all of your receipts, you can upload them into the HSA system, and you will start seeing a balance for what you can pay yourself back. And if that balance gets to $10,000 over the next 10 years or $20,000 over the next 10 years or whatever it comes to, you could withdraw that money and it will be tax free right to your pocket. Of course, you've already paid for this, but it's just another benefit that I see that people can use when they get into retirement or just in retirement, having that HSA that was sitting there making money for you so you can pay for your health insurance in your later years. It is also portable. So if you have an HSA and you want to change plans because this other health plan might work better for you, as long as you do the high deductible health plan and it offers the HSA, you can just transfer it over and continue to have that money put into your HSA. So, what are some of the downsides? If you take out the money before the age of 65 for any reason other than medical, you will get a huge tax hit on it. So not only will you be taxed at whatever rate you are in, depending on what your tax bracket is, and I'll try to go over that in a later video also, but you'll also get hit on an extra 20% tax hit. So if you don't want a tax hit, you either have to keep your receipts, put them in there. Always keep your receipts anyway. But once you upload your receipts to your HSA account, you'll gain that money in there that you can always withdraw. So if something happens, maybe use it for a rainy day, whatever have you. You can take that money out because it's saved in there. You can always use this money at any point in time, again, for any medical. But if you have your receipts in there and you've built up an amount of money, you can withdraw that at any time you might need it. So the age 65 is special for the HSA. Once you hit the age of 65, you can withdraw this money for any reason. You will get a tax hit on it, but it will just be whatever tax bracket you are currently in. So it'll kind of be like if you understand an IRA, a traditional IRA that you would be saving money for your retirement. It would be used in the same way. It's just money that's pre-tax that goes in there that hopefully you've made some money on, and then you can take that money out at a later date. You just get taxed at that tax bracket that you're currently in at that point in time when you take the money out. So that is another benefit to it. If you, again, take that money out before 65, there is that tax hit. So we want to avoid that at all costs. All right. So you always want to document your expenses in the sense of keeping your receipts, uploading them to your HSA, and that could be for glasses, contacts, as long as they're not colored contacts for your personal use, prescription contacts, so on and so forth. Upload all those receipts and keep them for a rainy day, or just to upload them so they know if the IRS comes banging on your door, you've got all your stuff covered. Because there's always that chance that you could get audited. It's very rare, but it does happen. So there's no double dipping also. So you can't get a tax deduction, then reimburse yourself later. If you do get audited, it would cause you some issues. So please don't do that. So let's recap just a little bit before I let you go. The health savings account is an account that you can use that will get funded by your health plan and yourself. And what you can do with it is pay for medical expenses and over-the-counter stuff. Also, dentist and optometry. Use that money in lieu of your own money, or if you're putting your money in there, you can use it combined. All that money will be tax deductible or tax deferred. No taxes. Remember the triple tax benefit. With that money, you can pay for all the stuff that might help you in the beginning and then maybe save it later in the end. So when you retire, if you have money in there, you can use it forever. It can transfer, and it has tons of benefits that I think are great for everybody to use. And again, if you're not using an HSA, I believe you're throwing away money. HSAs are great ways to create some wealth for yourself and use them for your medical benefit. Please leave me any questions or comments down below, and I will definitely try to answer those. And thank you for watching my video. Have a good day. Oh, and I forgot. I wanted to leave you with one thing. Why do you never hear a pterodactyl pee? Because the P is silent. Thank you.